Thank you very much. Very pleased to be here. The title here tells you the theme of what I'm going to be talking about. And I feel, after hearing our first speaker, that I don't really need to explain to this body what is meant by the word credit. But let me explain to you how I explain it to my students. Credit, I explain to them, is the outcome of a financial intermediation, and bank credit is one of the largest components of overall credit. And what I want to talk about today is the role of bank credit in the current financial crisis. So where are we? We're now 4 years after one of the biggest financial storms in history, and we're told that this has been the worst, the outcome of this storm has been the worst since the 1930s. How did we get here? Well, I think most of us know how we got here. We know that the subprime crisis was the detonator, but that wasn't necessarily the cause. It spread out to the rest of the world because of the use of derivatives, and which made it highly interconnected. But I think most people accept that one of the prime reasons of how we got here was that for the previous decade, we had a period of cheap credit and generally the underpricing of risk. And that was one of the major factors, plus a lot of other economic factors such as global imbalances and so on. But the credit growth during the last decade prior to 2007, 2008 was phenomenal. And this has led to, in the West, a real estate speculative bubble, which then crashed in 2007, 2008 with the outcome which we are familiar with. Well, it's the worst recession since the 1930s, so it's best to compare this with the 1930s. And what you can see on this chart is that the blue line is where we are now. The green one is what happened in the 1930s. And a couple of interesting things here. First of all, look at the depth of the downturn. It's very similar. It's certainly true to say that this is the worst recession since the 1930s. This is for the UK. But what's different? What's different is that the recovery, the green line, you can see that we've actually recovered in the 1930s, about this time, compared with the 1930s, but we're still somewhere, in the doldrums. We're still way below. So it's not just the depth of the downturn, but we're stuck in the downturn. I just want to go through some of the similarities and dissimilarities. Well, certainly there are some very strong similarities, both the 30s and the 2000s recessions, both preceded by asset price bubbles, fueled by bank lending. For those of you who know your history, it was the 1929 Great Crash was a credit-led boom. They both were triggered by a realization of the overvaluation of real estate, especially in the USA. Both resulted in bank crises triggered by a major bank failure. It was the Kreditanstalt in the 1930s. It was Lehman Brothers in the 2000s. Both recessions experienced debt deflation and would say it's still ongoing. And both included a collapse in world trade. But there are substantial differences. First of all, fiscal policy. Government debt in the UK was very high. We just come out of the First World War. It was something like 175% of GDP. But fiscal policy was very tight. Austerity was the thinking of the Treasury at the time. The budget deficit in the depths of the recession was only 1.5% of GDP. Of course, quantitative easing didn't exist. There was no such thing. There was also no bank run. That was an interesting thing, because during the depth of the banking crisis, there was no bank run on any British bank. There was no sovereign debt crisis that threatened the world economy as it does today. There was no trade war, or rather there is no trade war. There was a trade war in the 1930s as tariffs went up and beggar your neighbor policies were implemented all over the world. But one big difference between the 1930s and now was the supply of bank credit. Because, what happened was that when Britain left the gold standard in 1931, interest rates were dropped. They were dropped to very low levels historically. And that initiated a credit boom, which led to the housing boom of the 1930s. 1933, 34 was peak years for house building. And you can see this in this chart here. You see, again, look at the green bars. That's where we are now. We're talking about, I'm comparing 1929 onwards with 2007 onwards. You can see that in the first few years, bank credit was pretty strong, 2007, 2008. But then after that, it gets very, very low and stays low. But you compare that with the blue bars, which is bank credit during the 1930s, from 1929 onwards. Yes, it went negative, it's not surprising. There was a pretty serious recession at that time, but it became healthy in the recovery, and bank credit actually expanded quite rapidly. So, after the fall from gold in 1931, the Bank of England followed an independent monetary policy, because while it was on the gold standard, it couldn't follow an independent monetary policy. And it brought in a policy of cheap money, and bank rate fell to 2%, market rates fell to less than 1%, so that's familiar with what we have now. Although there's no such thing as quantitative easing, on the surface money was cheap, and a housing boom followed. Let's look at these short-term interest rates. This looks just like the way the Bank of England responded for the 2008 crisis. Right? Bank rate was around about 5.5% to 6%. It came tumbling down to 2%. And short-term rates went below 1% and were just touching 0.5%. Mortgage credit growth, again, you can see from these charts. Again, I'm comparing the 30s and the 2000s, starting with 1929 and 2006. You can see that although mortgage credit was high in the 20s and it dipped a little bit in the depths of the recession, it really rebounded. Whereas what we are seeing now is that mortgage credit might have picked up a bit in 2008 and 2009, but now it's very, very low. And we're not sure how it's going to pan out. Fast forward, we can look at also unsecured credit, the personal sector. This is very interesting. The red line here shows the rate of growth of unsecured credit forwarded by the monetary financial institutions. That's the banks and the building societies. What you see is that we're now in negative territory. That growth is negative. So what we're seeing is just credit payback. Right? There's no net credit being advanced. If you look at credit cards, which is the green chart, again, there was a bit of a leap at one stage, but then we're now in negative territory. Okay? So what's happening? Gross credit might be increasing, but this is net credit. Actually, people are paying back their cards. They're paying back their credit. Why has credit growth been so weak? Well, let's look at the fundamentals. Right? This is a little chart of how the economy works in terms of looking at households and firms. Households, you can argue, borrow because they want to consumption smooth. Right? They're borrowing from their future income because they want to smooth their consumption over their lifetime. For that to occur, they've got to have expected income growth so they can pay it back. Firms, well, they use credit for two things. There's trade credit so they can transact with each other, and they need credit for investments. These investments are used to produce goods which represent future output, which this future output is translated into future income. Okay, so that everything fits together. Borrowing occurs only if, in general, of course, only if people think that they can earn more in the future to pay it back so they can consumption smooth over their lifetime. What's happening is that people don't expect their future income to grow. They're expecting it possibly to fall or to stay the same. And similarly, firms are not investing because they don't see either demand or the capability to actually produce goods that can be sold. So, why is this happening? Well, we have weak consumer demand because households are deleveraging. Right? They're repaying debt. They're trying to reduce their amount of debt, and to do that, they have to increase their savings. Increasing their savings means reducing their consumption. There's a consumer credit slowdown because of uncertain future income. We've heard from our first speaker that mortgage lenders are now a lot more cautious. And SMEs are complaining about the availability of credit. However, if you look at the figures, you'd think that actually money was cheap. We have quantitative easing, but who have been the beneficiaries of this? The beneficiaries have been the large companies, because they take advantage of quantitative easing to restructure their debt. They do that by going to the bond market, issuing bonds, and using the low interest rates in the bond market to repay bank debt. So they're restructuring one type of debt for another type of debt. And it's cheaper because quantitative easing has made it possible. Of course, on the part of the banks are now a lot more cautious and they are conserving cash. So demand is weak. Right? Demand for credit is weak, but so is supply. Now, weak demand is understandable, and the whole purpose of quantitative easing is to generate demand. Quantitative easing works by buying up financial assets, largely gilt-edged securities, but it works in two ways. First, by buying these up, they're buying them from the non-bank financial institutions. These financial institutions then become cash heavy, and they would invest in stocks and shares, and shares will then rise, or rather it will arrest the fall, and households and firms will feel wealthier as shares rise, and then they will spend. That's the theory. Similarly, they will buy gilt-edged securities from the banking sector. The banks will become cash heavy, and the banks will have too much base money or reserve money, and they will want to go out and lend. That's the theory of it. Okay? But the trouble is that supply is state contingent, because the state we are in now is different from any other time that the banks have experienced. We're not just seeing an ordinary recession, we're seeing a regulatory backlash, and we're bashing the bankers. And I'm pretty sure they all deserve bashing. But the question is, when is the right time to bash bankers? When they're down or when they're up? All right? Bankers are flat on their back, they're not lending, and we continue to bash them. The Vickers report talks about ring fencing of the different activities of banking, from the investment banking and the retail banking. Basel III, which will be implemented from 2015 on to 2019, talks about higher capital ratios and higher liquidity ratios. Banks are not going to get capital from their shareholders, not now, not where share prices have hit rock bottom. They have to get it from their profits, and therefore they're conserving cash. Hence, they do this by widening spreads. Right? It's the only way they can obtain cash is by widening spreads. They have to have higher liquidity, which of course earns very low rates. So already that's a tax on their activity. They have to hold more capital. Right? That's expensive, and they have to obtain that from themselves, not from their shareholders. So we can see what determines the interest rate spread. Well, there's the liquidity cost. And theoretically, the liquidity cost should be low with bank rate at 0.5%. But in fact, speaking to bankers, you say that's not what they can get. We already know about the LIBOR scandal, where banks have been saying what rate that what they should be getting as to what rate they actually do get. Yes, operational costs are part of that spread. Market power is part of that spread, and it's certainly true that as a result of lots of mergers, the banking sector is a lot more concentrated, so it's possibly there's some market power. But the main thing here is risk. Right? The risk environment has changed, and that has increased the spread. And finally, capital. The capital charges now that our banks are expected to actually incur on their lending has meant that there's a rise in what you would call RAROC, or risk-adjusted return on capital, and that has to be entered into the spread as well. So all these things are working to widen spreads. So credit actually isn't that cheap, right? It should be cheap, but it isn't that cheap. We have a history, we have unorthodox monetary policy, which is supposed to make funding and credit cheap. We have quantitative easing in the USA, quantitative QE1, QE2, QE3 now. And in the UK, the Bank of England is QE1 and QE2, about 300 billion of quantitative easing. Well, what were the initial effects? The initial effects were positive in the sense that the non-bank financial institutions, being cash-heavy, actually used that to repurchase assets, and the asset markets reacted. So from the initial fall, asset markets rebounded because of quantitative easing. So that's a good thing. But the banks, that's different. The banks in the USA and the UK held on to cash because liquidity ratios were raised, capital ratios were raised. Banks also began to play the yield curve and round trip on the bonds that the governments were purchasing. Right? The government would purchase bonds and gilt-edged securities from the banks. Right? They would do that at a premium, and then the banks would then rebuy them at a discount, and therefore then sell them again at a premium. This way they were playing the yield curve and trying to make money on the yield curve rather than lending, because that's safe. Quantitative easing depressed bond yields, I've already said, and large companies were then able to use this to their advantage to issue corporate bonds, and big companies used these lower long-term interest rates to restructure debt by issuing bonds and paying off the banks. Now think about the economics of this. The companies that can use the effects of QE to restructure their debt are the good companies. They're the good risks. They're the ones who are repaying banks. That means that banks are left with the less good risks. Okay, so the loan portfolio becomes more risky because the good ones are going to the bond market. So that increases riskiness, widens the spreads. On the other hand, when we look at savers, right, we have artificially low interest rates, and savers are getting very little for their savings, and that's a situation of financial repression. Yields on savings have been hit, they're very low, but borrowing rates for SMEs have not fallen, and the spreads have widened. The result of this is that in any recession, capacity gets destroyed as outdated capital gets destroyed, as there's substitution and switching going on in the economy. But you expect a rebuilding as interest rates fall. Firms will rebuild by creating new capacity and capacity rebuilding. Well, let's have a look at a longer-term perspective here to see whether we are getting this capacity rebuilding. We're looking at 3 recessions here. The Thatcher recession, the ERM recession, and the current Great Recession. What do you notice about the first 2, Thatcher and the ERM? Yes, there's a drop, similar kind of magnitude, but then it's a pickup. We get back onto trend. GDP gets back onto trend. Look at the current recession. GDP doesn't appear to be getting back on trend. We're flatlining. Of course, it's too early to say. Maybe next year will be the year that we will see an upturn and get back to trend. But, I wouldn't hold your breath. It doesn't look like a very nice pattern here. What's happening is that capacity has been destroyed, but capacity is not being rebuilt. The low real interest rates and cost of capital in the 1990s and 2000s have actually led to overinvestment. And this is something that Schumpeter argued would happen as part of credit booms. Schumpeter was a famous economic historian who talked about credit cycles that every 50 years will lead to this kind of event. And what you got is overinvestment. Overinvestment particularly in low value added consumer sector in the Far East. We've also seen speculative bubbles. a revaluation of expectations as a result of the crash in speculative bubbles. All these things contribute to capacity destruction. Oil price, right? The world must be different when oil prices are in the $100 region as opposed to 30, which was, a few years ago. And also recent research published in the American Economic Review have been looking at financial crises and looked particularly at the Asian financial crisis in 1997. And they showed that actually, as a result of those countries that were affected never ever recouped the output loss. So there was permanent capacity destruction and not enough capacity rebuilding. What we need is capacity rebuilding, and to do that, we need better credit growth. We need the capacity to take advantage of growth opportunities in the Far East. Luckily, we're not in the euro, and therefore we were able to, our exchange rate was able to devalue, but that's a great improvement in competitiveness, but there's a supply constraints, right? We're unable to take advantage of this. We need to stop bashing bankers, even though they deserve it. We need to get credit moving first. Now, the government's funding for lending scheme, I thought, was at the Shadow Monetary Policy Committee. We discussed this and we thought this was a good idea, that this should work. But on my BlackBerry this morning, I looked at the FT notes I get, and it said funding for lending has not led to any increase in credit growth, neither mortgages or lending to SMEs. So, although we know what we have to do, we have to get credit moving, it may be that the banks and demanders for credit or the suppliers of credit are waiting to see what happens in the bigger picture, the sovereign debt crisis. We have global uncertainties, and these global uncertainties do not help, but that's where we are right now. We know what we have to do, but trying to get that is something that we have to ponder about. Right. Thank you very much.